Japan's public debt is over 250% of GDP, the highest among industrialized nations.
Bond yields are surging, signaling a structural heart attack in the market. For decades, the Bank of Japan suppressed yields, buying government bonds to stabilize markets. Negative interest rates became the norm, fueling the famous yen carry trade worldwide. But rising debt with higher interest rates is a dangerous combination. Historically, Japan has been an anchor of global capital flows. When Japan falters, U.S. Treasury yields and global bond markets reprice almost instantly.
European bond yields could spike, increasing borrowing costs across the continent. One small misstep in Japan can trigger a wave across global financial markets.
Investors worldwide could see portfolios affected instantly.
For over 30 years, Japan maintained ultra-loose monetary policies.
The yen carry trade fueled cheap borrowing and global liquidity. Recent rate hikes are starting to unwind this trade.
Unfunded tax cuts are increasing fiscal pressure and widening Japan's budget strain.
This could trigger deleveraging across multiple asset classes. Japan's economy is constrained by a declining workforce. An aging population limits growth potential.
Competition from China in key industries like automotive pressures Japan's exports.
China's deflation and global competition exacerbate Japan's economic challenges.
Economic growth remains weak despite decades of stimulus. Japan faces a critical 90-day period, starting with the February election. Sprung wage negotiations could further impact market stability.
A probable Bank of Japan rate hike in June could trigger major market moves. Any misstep during this window risks cascading effects worldwide.
Investors must watch carefully as risk spreads globally.
The unwinding of the yen carry trade will force liquidation across asset classes.
Institutional investors repatriating funds remove a key pillar supporting markets. Borrowing costs could rise worldwide, affecting governments and corporations.
Equities, bonds, and commodities could all take a hit.
This is not just Japan's problem. It's a global warning.
When debt reaches 250% of GDP and rates rise, the math stops working. Higher interest rates make debt repayment unsustainable. Bond market stress is nearing a tipping point. Global investors need to prepare for potential volatility. A single trigger could cascade through the world economy. The next 90 days are critical. Investors should stay alert. The unwinding of decades-long trades could reshape portfolios globally.
Every major market feels the impact, US, Europe, and Asia are vulnerable.
Japan's bond market is a $20 trillion time bomb with global consequences. This is a global financial story everyone needs to follow closely.